So you've got incentive stock options, ISOs. But what most people don't realize is this. When you sell those shares can change your tax bill drastically, even if it's the exact same stock. Let's walk through three possible outcomes, from best case to neutral to worse, so you know what you're dealing with. First up, the qualified disposition. This is the best case scenario. This happens when you sell your ISOs at least 1 year from exercise and 2 years after they were granted. Why is this the best case? Because it unlocks the holy grail of tax treatment, long-term capital gains instead of ordinary income. And if you paid AMT when you exercised, you can start to recover some or all of that later. Here's an example. You exercised 2,000 ISOs at a $15 strike price. The fair market value at exercise was $30. You hold the shares and sell them later at $60 per share. What does that mean for your taxes? At exercise, the bargain element, that's $30 minus $15 times 2,000 shares adds $30,000 to the AMT calculation. But because you held long enough, the $90,000 gain from 15 to 60 qualifies as long-term capital gains. And here's the kicker. When you file your taxes, you can claim a negative adjustment on IRS Form 6251 line 2K for that $30,000. That triggers the AMT credit recovery. Now let's look at a neutral outcome. This is when you exercise and sell in the same year. This is called a disqualifying disposition, and it changes the tax treatment entirely. When you sell the ISO shares in the same year that you exercise them, the IRS says, thanks, but no special tax treatment for you. The shares are taxed just like non-qualified stock options, or NSOs. Here's a quick example. You exercise 2,000 shares at a $15 strike price. The fair market value on the date of exercise is $45, and you sell them at $50. Your tax result? The $30 spread between 15 and 45, that's $60,000, shows up as ordinary income on your W-2. The extra $5 per share from 45 to 50, that's another $10,000 of short-term capital gain. Remember that short-term capital gain is taxed just like ordinary income. The upside, no AMT, but also no AMT credit. This is a clean, simple outcome, but not the most tax efficient. And finally, here's a scenario you really want to avoid. You exercise your ISOs this year, but sell next year before hitting the 1 year and 2 year holding period. Still a disqualifying disposition, but this one's the worst case outcome. Why? Because now you've triggered AMT when you exercised, and you locked in that AMT when the calendar year ended. This means you don't get the long-term capital gains treatment. You're paying tax on phantom income, money you never actually pocketed. Here's what that looks like. You exercise 2,000 shares at a $15 strike price when the fair market value is $60. That $45 spread adds $90,000 to the AMT calculation. Then the market drops. Next year, you sell the shares at $55, which is less than the value at exercise. The tax hit, you already paid AMT on $90,000, but your actual gain was only $40 per share, or $80,000, which is taxed as ordinary income, not long-term capital gains. You take an AMT adjustment of negative $90,000 on IRS Form 6251. This helps you recover some credit, but it could take years. Bottom line, you pay tax on income you never realized, and you missed out on the best tax treatment. ISOs can be a powerful wealth-building tool, but only if you understand the rules of the game. Timing isn't just everything. It's the difference between long-term gains and long-term regret.